We spent a lot of hours in the Monetary Policy Committee and reaching our conclusions. And one of the issues that we've been really wrestling with, and obviously I should say that there's been a very big movement in market interest rates during the course of August and September, and particularly when the market was going through a very turbulent period in the second half of September. Now, we've seen some of that reverse, but it's still in the course of doing so. And so we spent a lot of time saying, how can we, in a sense, reconcile our view of the economy, our view of inflation, and where it was going to go to with the market curve? And we do this partly through our forecast. And we found it very hard to do. So, you're correct to say, I regard it as a very high bar for us to comment explicitly on market rates. We tend to use them as a conditioning assumption in our forecast. We discuss them a lot in our meetings, but we don't tend to pass judgment. But the gap was so big now that we felt, this is not only a difficult issue to come to terms with, but it's going to have a direct effect on the economy. It has a direct effect on mortgage rates, for instance, in this country.
But, even after what you said today, markets are still pricing in a peak interest rate of 4.67 percentage points. Have the markets just misunderstood what you were saying, or are you happy with?
Well, I'm not going to say what we've been very clear. We don't have a rate in mind for the future because we take our decisions meeting by meeting. I would say this, though, that 4.6% rate compares to the rate we had in our forecast, which is only a week or so ago in terms of when we finished it, of somewhere around about 5.25. So you can see how much the market's moved even during that period. And if you go back in time, you get to rates over 6%. So the market has moved a lot.
Do you think we're getting closer to wait and see mode, though, given your updated forecast today?
Well, I would also stress another point in our forecast, which is we have inflation coming back down to target and going below target, actually. But we have one of the largest upside risks to inflation in our forecast that we've had in the 25-year history of the MPC. A lot of that has to do with the tightness of the UK labour market. The UK labour market is very tight. Labour force has shrunk since immediately before COVID. So there are risks. And it'll be those risks that I think will have an important impact on how when we next meet in December, and then thereafter, how we think about policy decisions. So I'm not going to give you a view on what the next rate move or not is going to be.
Well, I know you're also not going to comment on what the government are going to do because no one knows at this point. But if we do end up in a situation where the government did deliver on fiscal tightening, does that take the pressure off the Bank of England to tighten rates?
Well, we would put that into our assessment process and into our next forecast, and it would be part of the conclusions because we do condition our view on what we call announced government policy. We had to sort of think about slightly reconfigure that this time for the energy policy, but I expect we will get a set of announcements when the Chancellor makes a statement, and we will take those into consideration.
Now, over the last couple of weeks, we've had the likes of Bank of Canada, RBA, today Norges step down a little bit with their pace of hiking, namely about concerns on what higher interest rates do to mortgage rates and the impact that that's going to have on the real economy. Is this less of a concern for the Bank of England?
Well, the mortgage rate and the mortgage housing market, of course, features in our assessment of the economy in the same way as I'm sure it does for other central banks. So we're all keen followers of our housing markets and our mortgage rates. I think the other thing I would say is, of course, what ultimately we target is inflation, price stability, and that will, of course, have a big impact on what future mortgage rates will be. So that's important. I would also say that I don't expect that the rate increase that we've made today will feed through into those who've got variable rate mortgages. I would not expect it to do the same into new fixed rate mortgage deals, and those are the largest part of the new market in this country for two reasons. One, because the market had actually priced in what we were going to do today. They just concluded that that's what we were going to do. But secondly, this point I've made that we think the curve went too high. And we've made that point explicitly, and we'll leave the market to reflect on that point. And that will, of course, influence future mortgage rates.
And I know this was an MPC meeting, but I just want to ask you one question about financial stability risk.
Yes.
Would you deem them to be less today than they were, say, before all of this kicked off, before the mini budget?
Well, I mean, we had to deal with a particular, quite marked financial stability risk in this country, set off by the very pronounced movement, particularly in long gilt rates in this country. I think we have dealt with that now, so that particular issue. But I think it does point to a whole set of sort of, whole part of the landscape, particularly the non-bank finance world, which we've got to, globally, got to have much more effective scrutiny of, because we've had a number of what I might call incidents in that world. And this certainly dominates discussion in the Global Financial Stability Board, for instance. So I would say, in terms of our sort of surveillance of the landscape, I think the alert level is pretty high, frankly, at the moment, because we have had a few, quite striking incidents.
Hi, I'm Joumanna Bercetche, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.